Not financial advice, only my own and other speakers' personal opinions. This does not encourage nor promote taking any trades, positions, or investments of any kind. Any information contained in this conversation is for informational purposes only and to be taken as is. Derek Wong and other speakers have done their best to ensure accurate information. Regardless of anything to the contrary, nothing available in this conversation should be understood as a recommendation. Consult a licensed financial professional in your jurisdiction. So today's topic is on volatility measurement. And I think we can broaden it a bit to just kind of how to use volatility in general. And I have a few notes here because volatility is actually quite complicated. So I kind of broke it down into four types of indicators, you could call it, or indices that people may be using to measure volatility. And the first one is historical volatility. I mean, that's a classic ATR, or you might be doing the standard deviations of closes, and that's historical volatility in the price space. The next idea in the historical volatility space is also returns. And again, there's many variations of this. You could do percentage returns, you can do log returns. It's already a transform of price and normalization. We also have implied volatility for the options people around, and its kind of implication. Again, there's multiple ways to do this. I think we'll just stick with the simple Black-Scholes method. Another kind of contentious area is a volatility index and the usage of the VIX or V stocks or whatever you're using, something that is deriving a number from implied volatility, but actually creating an index that may be traded itself or have derivatives traded on it, but also people use it as some kind of indicator for like risk on, risk off, and it's quoted on news media quite a lot. And then finally, I have the intraday volatility or high frequency volatility. And I will include, tick volatility all the way to like minutely or maybe hourly. The farther away you get from super high frequency, the things kind of become more like daily, but there's definitely a gradient there. So I just, put everything in kind of intraday, things that are less than 1 day volatility, because there's a whole different set of problems that come with estimating intraday volatility. And there's also some benefits. I will discuss. Well, I will just set the scene a bit first. I'm personally a fan of using returns volatility, specifically log return volatility. I also have used historical price volatility. ATRs is the classic. I mean, that's definitely something I'm using. I do think transforming to returns does have some beneficial properties, which we can discuss later. And I will leave implied volatility kind of to the side because that opens a whole can of worms. But say VIX or vol indices at intraday volatility, I also think is very interesting because, and I will link that back to ATR. The reason why people prefer ATR is because it actually has like some small component of intraday volatility because you're actually taking the high and low as opposed to just the close. So again, this is kind of like a full circle of different volatility measurements, and I will leave it open to the floor on people how people use volatility, but also how they've decided to measure it.
I suppose the only volatility measure I do use is ATR, so I use that as a basis to normalise volatility across the different markets, which I find very useful for the particular type of trend following strategies I trade. So, I might use a 25 period look back of ATR, and that means that we might get periods where volatility expands, and under that situation, because I use ATR as a method for position sizing, as volatility expands, then my position sizing might decrease, but as volatility contracts, it might increase. I suppose there are pros and cons of that. The fact is that during fairly suppressed volatility periods, that might find that your position size does become too heavy. So that when you do get a volatility expansion, you find that you're probably carrying too much position size, too much leverage in that. But as a general sort of principle, ATR has been very useful for me.
Actually, I think that that's a great kind of door to open on the usages of this volatility measurement. I mean, yes, measuring it is one thing, but the application is another. And I do think that position sizing is really important aspect to consider to do it. And I think that's probably the most traditional way. And I want to open it up to Bruno P. I know he's around because I think he will be the vol usage master.
Yeah, so well, I don't know if I'm uh, the master, as Derek put it, but I'm definitely an avid user of volatility. Um, and the most important use that I'm making is to define the environment. Again, when we talk about volatility, people think about standard deviation, and we all agree that standard deviation is not risk. Um, and also, we spoke many times that our returns are probably not normally distributed, so standard deviation by not even make any sense. We could live in a distribution. Certainly, parts of the distribution could be, not even having a scale. So you might not even have that sort of thing that we call standard deviation or volatility. So the first point that I think we need to focus on is how we measure this thing. And Derek brought up semivariance, which I think is what we should really focus on. Richard keeps talking about MAR, so he likes to look at risk in terms of drawdowns, which is another good way of looking at things. Obviously, there's this difference in Jerry's and Richard's approach, in that their risk is only relates to closed equity and not to open equity. Open equity is sort of free money; they can do whatever they want with it. um, I tend not to segregate equity accounts as much. For me, open profit are every bit as part of profit as closed profit. So um, you need to treat them the same. But yeah, I mean there are various points where our approach is so to converge. I don't use ATR per se because I'm trying to estimate volatility a bit more explicitly. And so, how do I do that? Well, I call this, a volatility model. It's certainly not standard deviation or rolling standard deviation or exponential standard deviation. It's a little bit more than that. And it goes back. We talked about latent processes and stuff like that. It's trying to understand basically when markets are just moving because it's part of the natural ebb and flow, or is there's something more to it. And so this model, which keeps evolving, is trying to ascertain that. And this past week has been a fantastic example. Do we believe that we should be buying this dip and nothing happens, or is this the onset of a change in regime or something like that? So these are the questions. These are um, the sort of um, ideas that I want, my model, my volatility model, help to help with, basically.
It's interesting you talk about this week. I think on Friday, the Black Friday volatility, I was reading somewhere, I think it was the fourth highest volatility we've seen. So it was a particularly big move. And I certainly was caught with a lot of my directional trends being hammered.
I feel your pain, Richard. Uh, and it is one of those cases where, a lot of open trade equity, I'm going to have to explain uh, what why that happened because, when your NAV is struck, it doesn't really matter. But that's besides the point. I do think what Bruno was saying, and then these kind of vol spike events, there's two things going on there. Volatility is important because of path dependency, right? So when we think about volatility, we are in fact estimating a distribution, and we're talking about the width of this distribution. And if you think about it that way, then you can slice and dice it as you wish. And that's why what I brought up is semivariance is quite important. And, we've seen this in kind of like people may be familiar with Sortino and things like that. but the idea is that it doesn't necessarily need to be symmetrical. And of course, when you add all of these things, we always go back to the complexity of it. But what I hear from Bruno, I think is quite interesting, using it to see when things are not normal. So, like this is my impression. I mean, correct me if I'm wrong, but he's slicing the volatility such that he's focusing on the tails. Like, if you know that there is such distribution, and then he's able to identify using the volatility to identify tail regions. Is that right, Bruno?
Well, yeah, perhaps I'm overselling it a little bit. The answer is yes. I wish I was, proficient at doing that. And I'm adding some layers to the current model to do exactly that. But the perhaps a more basic way of understanding the problem is also I'm sizing my not just my every single trade, but my capital based on the level of perceived risk in the market. So yes, it's about tails. It's about trying to sort of understand. So I'm really grappling, like all of you guys, with this question: what happened last Friday? Is just some weird moves in an otherwise fairly illiquid market, or is this the onset of a new regime or the end of the rally or whatever? So I'm trying to answer this second question, but first of all, I have to have a measure of risk. And risk, yes, is it's one-sided with respect to upside risk versus downside risk. I don't care about upside risk at all. Actually, I'm very happy when things are volatile to the upside, because things are good. But I'm also interested in figuring out how much capital every day I need to deploy contingent on market conditions. So it's this thing that I'm trying to do, perhaps more than identifying are we in a tail condition or not. I'm trying to say, okay, given where we are in the market today, I should be with risking X, tomorrow risking Y. So basically, what happened last week, at the end of last week, because of the sudden moves, I found myself running a little bit ahead of a little bit ahead of myself. So the first thing that happened, I cut pretty much horizontally through the portfolio, and vertically through the portfolio, and just cut positions by a certain amount, regardless of whether it had big drawdowns or lesser drawdowns, because the total amount of risk that I'm allowed now is far lower than it was just on Thursday. Hopefully, this answers your question, Derek.
I actually read that article from 2 Sigma where they're talking about Gaussian mixture models, which is a way of effectively clustering normal distributions by virtue of, I suppose we're looking at volatility clusters. Is that right, Derek? But I was actually intrigued by thinking that maybe that there is something in this machine learning process where we can basically, through regime filters or market regimes, basically more sort of accurately define the nature of the distribution that's produced in that regime to give us some sort of form of indicator, effectively, that I'm assuming it's always lagging, but I'm just wondering how we can use those models.
I have played with Gaussian mixture models, maybe 3+ years ago. When you sent that, I was like, oh boy, I better brush up. Um, Gaussian mixtures are really interesting for the most part, because each individual component is still a Gaussian distribution. So you retain a lot of the nice tools that you have. Um, the problem that I had when I was doing it is very similar to like hidden Markov. How many of these mini distributions do you need to create the right amount of different situations? And I think that that was something that, like, that was the key takeaway I got from that. 2 Sigma was like they have 4. Now, um, I think it does have some logical sense. They have these four regimes, and they explained kind of like the economic sense behind it.
Yeah, one of them was an inflation model. So 3 made sense to me, but then when they put the inflation model in there as their fourth model, I thought, why?
And I was looking at, they have, I think, 17 or 19, or I would say like almost 20 factors that are going into that to determine um, what this thing is. So it's not just from the price returns, which gives them a lot more information. And potentially what is happening is that obviously one of these four Gaussian distributions, when things are inside that area, it's mostly affected by that factor. It will affect the volatility. So if we go back to my work, I can't really speak to their work, but in my work, what I found is if you do have some kind of regime filter, whether it's just two, say normal and not normal, or bullish or bearish, or you could have four, you say like right tail, left tail, slightly to the right of the average, slightly to the left of the average, but we're still kind of in the middle zone. However you break it up, the returns that occur in those areas do have differences. Now, again, my issue was I didn't have an economic rationale to come up to why I think I had three. Like I think I had one really volatile one which was kind of middling and it didn't really know what it was, and then one was more skewed to the long side, just because a lot of things make bigger moves to the long side. Because I mean I was doing it on what you would think a CTA strategy is. So that was kind of what I had determined. And when I looked at, say, when things were classified in these regions, you would find that, like, if it was classified in the long side, I was only using basically returns. You would see, yeah, actually, these things are positively skewed. And when things are highly volatile, they might be slightly more negatively skewed, but the volatility was just incredibly high. And what I did find was a major contributor to that was the equities, because they have this like high volatility, everything going down component. So like I didn't know how to strip that out. And then in the middling zone, it was just what I would consider the noise section. But that's all I can really tell you based on my work.
Um, I don't know what I don't know. I haven't read the article that you guys are talking about, and I can't really comment on that. I did, however, have a play with Gaussian mixtures in a previous life when I needed to be very careful about skew and tail and sorry, skew and kurtosis on in the tail of certain distributions. So they work, but all the comments you guys made make perfect sense to me. The fact that how many Gaussians do you need? What's the mixing parameter between the different Gaussians in order to recover this sort of a meta distribution, which is this the mixture. So yeah, I mean, like that's the hard bit. However, Gaussian mixtures have the undisputed property of using Gaussian math to produce a non-Gaussian. So more to this point, and let's talk about my more recent work or interest, and back to the volatility model that I keep hammering on. I'm using a Gaussian, what is called as a Gaussian process. So a Gaussian process is again an extension of these things. It's a Gaussian, of course, but process being a collection of functions, it's a Gaussian made of lots of different Gaussian functions. So your market samples out of this inside this big thing called the Gaussian process. I just want one of the possible many instances that the process can render. And so everything it's a little bit easier because you don't really need to fit to that particular sample that you're collecting. You fit around that sample. So there's the concept of this loose fit. The complication, of course, is that you need to specify a mean and function and a covariance function for this Gaussian process. So everything becomes a little bit more cumbersome. Computation is much more involved because you have to control lots of different dimensions. Back to one of the articles that Jerry tweeted out, this Katy Kaminsky fund and her use of kernel regression. Obviously, Gaussian processes build very heavily on that. You've got lots of kernel tricks to visit high dimensional spaces and come back with a relatively parsimonious representations of those. So yes, I mean, I think the technology is there between, I don't know if mixture is the right answer. To me seems Gaussian process to be the right answer. I tweeted out a paper last week. Well, it was more than a paper, it was an article on towards data science. And those guys had a fantastic picture in there, a process that was exponentially and then had a big crash. And it reminded me of what just happened in the market. These guys are material scientists. I think they talk about some applied materials. Has got nothing to do with finance, but it's very fitting. I think if somebody is interested in doing something in volatility space, Gaussian processes perhaps are the way to do. And yes, they are not simple. They are not as basic as a line of Python to get your rolling standard deviations or whatever. But I think they get a much more interesting and useful representation of volatility. And back to Derek's point, I think that's what could be used as a regime shift or phase detection model as well, because you can see when your correlation structure keeps changing by sampling around, and the Gaussian process allows you to sample from samples you haven't actually recovered, just because you go through your sampling history and then say, okay, that's only one possible instance. I'm really interested in, I don't know, a particular section of your sampled history, and have the Gaussian process produce alternative samples. So it's really good as a data augmentation technique. So yeah, I suggest anybody who's interested to take a look at it.
Thanks, Bruno. Look, one of the things I just have a concern about is I think it's, looking in hindsight through these distribution models, it's quite easy to define particular distributions. However, what is the lag? How quickly can we act on that distribution, that change in distribution? So with your models, Bruno, do you quickly jump in? How do you detect that the new distribution is forming? Because at that particular time, your data sample will be small. How do you determine a valid time to say, right, this is a new regime with a new volatility, time to act on it?
Yeah, that's, first of all I'm telling you about now is research. So, it hasn't qualified for implementation, just because I definitely want to understand a bit more about the very, very fitting question that you raised. But let's go back just a few days and see what happened in the market. The question I'm asking myself is, again, are we in a different world or not? And with this machinery, it's possible, because you can say, okay, I have had a sample of a market jumping. Have we made it to a different regime? And then you can sample around this discontinuity and see if there's something in your past history that points out to a distinct moment or a phase shift in the past, or in other sample around other sample collections that produced similar results. So you can say, okay, is this something that I can ignore, or have I seen this in the past? When I saw it in the past, did it have the same hallmarks as it has now, or not? So, for example, one very interesting thing is this covariance structure that you put inside this machinery called the Gaussian process defines a lot of it. If you're saying, okay, I have 2 or 3 different or 4 different types of covariance in my history, and I think we have enough data going back, certainly the most mature markets, to experience crisis. I mean, we had crisis in the 80s, in the 90s, in the noughties. We have crisis now, or something that might look like a crisis now. We had a crisis last year. You can zoom around those crises, and you can say, okay, now sample around those points and see. Tell me what happened really in terms of correlation thing, the correlation structure. Tell me if the mean of the market changed. I mean, expected values change around this certain crisis. Somebody that worked suddenly doesn't work. So I mean, the machinery has the ability to give you these answers. I guess the importance, or I guess the the trust you have to develop around the process is whether or not you can react fast, fast enough or not. And I wish I could offer more insight on this.
I was just thinking that, like we're looking at identifying these phase shifts, and ideally we're looking at identifying directional volatility as opposed to just volatility per se. But I was just wondering whether we could actually identify that on the minute by minute time frame. So in other words, your regime filter is looking at the very high or the very sort of fine detailed time scale, like the minute time frame, developing a sufficient sample to be able to structurally position that distribution as a different form of distribution than what happened in the prior day or something. So therefore, a very sort of like a filter that is addressing a very sort of trying to get as much sample size as it can using small time frames, because surely you could identify a regime shift at any time scale.
Yeah, I think you could do that. I'm not doing that. I'm interested in something a bit more abstract, if you wish. I keep talking about latent processes and stuff like that. To me, it's really important, and it's really important to understand when we're not in Kansas anymore, when things are different, rather than follow the market very closely. So it's funny that I'm the sort of volatility fanatic, and you guys are the sort of loose fit. And it seems like the world is turning a little bit upside down, because I'm saying no, don't try and sample too closely around this covariance function, or this mean function. Just try to understand the general properties. But I actually think that certainly in my world, I really want to understand big changes rather than high frequency tremors. To me, the way my systems work, I'm trying to understand whether I should be cutting risk more aggressively or not, and whether my signals are precisely measured or not, rather than try and react as fast as possible. I think that's probably a better way of characterizing. I'm trying to be I'm trying to read the market as well as I can, rather than try and be as fast as possible in adjusting to it, if it makes any sense.
Yeah, it does. I was thinking that the two things that I'd look for a volatility-based model is, one, does it give you a signal to tell you when to turn your systems on when directional volatility gets to a point that you believe is more significant than what the normal distribution is implying? We're getting out to the tail region. It's implying that there's something different with this volatility. It's a directional volatility. Is this the commencement point of what we would call an outlier? And the second point is volatility used as a risk mitigation method to identify where to place your stops, trailing stops, that sort of stuff. So, yeah, no, I see what you're trying to achieve. Very interesting.
A lot of interesting stuff. I had to write down a lot of notes. What was just said in this conversation between Bruno and Rich. Uh, I mean, I'll start with the first one that Rich mentioned, and this was like intraday detection and reducing lag. I have found that like minute to sub minute volatility is different. I mean, okay, how do I explain simply? Okay. You will have fatter tails in the volatility in shorter time frames. Now, this does kind of go against the fractal nature of the market that everyone is assuming. The way I was able to kind of this is kind of in my research. The way I kind of put it together is that we just have so many more samples of minute and sub-minute data that maybe the real market at the daily time frame would approach this higher time frame, but because there are so many minutes in a day, you're getting so much larger sample size, it will be beyond our grandchildren's lifetimes when they get enough data that the markets are actually even fatter tailed than we see them, and we do the analysis on the daily time frame. You're getting these, if you were thinking in the normal world, like 4, 5, 6 standard deviation moves much more frequently than you would see in the daily time frame. So the regime detection aspect of using the shorter time frame for something that has even fatter tails than something at, say, the longer time frame that would have less fat tails becomes a little bit difficult. But that gets into the idea of regime filters. I have taken it differently in my approach to regime filtering. I am looking at two regimes, say like one is stable and one is unstable, and um, the change in the volatility is part of that regime as opposed to using the volatility to estimate the regime. So I use some macro factors that pump into the model, and the model says, okay, the market is fragile or susceptible to chaotic movements. It is slow because macro factors necessarily are printed slowly, right? But I have found statistical differences, meaningful statistical differences between the two regimes, and then that informs how you move forward, going with the position sizing, which I think that Bruno is doing, but he's doing it on a portfolio level for his volatility. Like he was saying that if on Friday he was able to detect, then he cut vertically through his portfolio. That's basically just reducing the overall risk of the portfolio, which you could imagine is like a kind of like a reposition sizing in portfolio space. And then the other part I have written down, too bad my handwriting is really bad. So I don't actually know what that says.
It says you're not getting enough sleep. Actually, Derek, on the point, yes, you're right that I have a portfolio overlay in terms of how much capital I put at risk every on every single trading session, but it also filters down at the instrument level. So there's two ways of effectively this volatility model looks at two things. One is the market data stream, and the other one is my return stream. My return stream is important, as you said, to figure out how much at super high level I need to deploy in terms of capital, but also the underlying individual price signals detect how well each signal each market signal each strategy signal is measured, and so they inspire my confidence, as you call it. So it's a two-dimensional monitoring of volatility, not just one dimension.
That's a good point, Bruno, because there are the two forms of distribution, and a lot of people sort of assume that trading a volatile market necessarily translates into a volatile equity curve, but it's not necessarily the case because, as we know, the return stream is sort of like a derivative expression of the system's constraints as opposed to the market's constraints. So a trend follower, for instance, can trade a fairly highly volatile market such as a cryptocurrency, but because they have their system design constraints that cut losses short, let profits run, their derivative expression of their return stream might not, certainly doesn't express the same volatility as the underlying market. And that's where I think, if we naively look at these Markowitz models, I think that, they're naively simplistic in that the assumption, I think, is that when they're talking about assets, they're talking about underlying markets as opposed to underlying systems that are trading these markets.
I'm thinking to myself, okay, we are using the volatility to detect regime, is measuring the volatility the real question, or is just getting back to what we're all kind of digging around and beating around the bush, um, actually just detecting these regimes and determining, do regimes exist that are different from other regimes? Going back to this kind of idea of using the volatility as a proxy for the macro constraints, or trying to think about how we apply these things, um, I do think that there is something here. I mean, I've been studying it for a while now, and I think we've all kind of examined this in our own, just watching the markets. There is something there. And volatility is an important component to all of our systems, because it's integrating in so many places, right? It's integrating into potentially this regime detection we're talking about. It's integrating into our position size or our portfolio risk, whether you're doing a trade size risk or you're doing the portfolio weighting method that Bruno is talking about. But it's also, um, like Richard was saying, it's going into that derivative of things that affects our equity curve. And all of these different aspects are like boiled down to this one thing. And I'm, I still struggle with this. What can we do about it? And going back to what Bruno said earlier, he's using this Gaussian process. I had gone a different. I actually looked at transforms. Um, it has like kind of similar issues, that you need to fit some parameters, but you're able to back out some fitting that has a smaller amount of parameters to make Gaussians non-normal and fit more the history. But then again, it comes with this lag. That I think is where, what we talked about before, having this Bayesian dynamic idea, whereby you are able to take in this new information. I'm not necessarily sure about this, intraday, but you would be able to update whether it's this Gaussian process or Gaussian transform to be able to do that. But how would you go? How would you go about determining that these regimes are worthwhile and you should take a different action? Because getting from the idea to research to implementation on something that is basically touching all aspects of your trading system, I am very conservative about, which is why a lot of these things live in research. Um, I don't really know how to deal with that. Would you just have multiple, volatility measures doing different things and almost consider them different signals or different overlays because you don't want to mess with what's working, but then that adds a different complexity. I like the idea of the ATR, in the traditional trend following way, because it's one thing that's guiding everything. When you start to have all these different overlays, you have many different models that might have different assumptions that are stacking on top of each other, and then we don't know what's the relationship between those two things.
That's a great point. ATR is just, well, to me, it's just such a phenomenal device because it's doing so many things for me. It's the volatility measure, it's a position sizing measure, it's the normalization measure. So, yeah, I'm very happy with that process. But we know that volatility, for instance, when we look at the impact of news events, FOMCs and those sort of things, these major news events, we can see that the news event, there's a causal tie between the news event and the volatility expansion. And I do see where you're coming from, Derek, in relation to using macro factors to basically identify these regimes in conjunction with your volatility measure. But yeah, I really wrestle with how do we address this lag, because that's where I like these what you were talking about before in the last few Clubhouse sessions about using options to get this convexity. So, Black Friday came. If I'd had options in my model, I'd have picked up those options for a sweet discount because, things were just going along sort of very low volatility, very beautifully. The premium would have been low. I could have picked up these options when things were going along, sort of put a bit of insurance into my portfolio, and Black Friday event, bang, automatically I'm jumping onto this volatility expansion, and I'm not getting the dent that I got on Friday with 6% drop in my portfolio value. So yeah, it's fascinating.
I think now we're moving from a sort of framework to inputs and or model parameters. I completely agree with what Derek said about the ATR being almost unbeatable in terms of in terms of being the Swiss Army knife of trend following. So yes, I mean, like, I am trying to do the same thing, but with a little bit more substance and basis. And again, does one go about doing that? Should you have multiple models, a bench, and things like that? So I think I mentioned before that there's a sort of idea generation phase or test phase, and then it qualifies for actual test with a de minimis, not even Jerry's 25 basis points, which are much smaller size portfolio, just to see if the theory stacks up with the reality. Because even having a one contract position in the market is infinitely better than testing ideas. So that's the second stage, and then finally, if that sort of research portfolio, I call it, if the research portfolio qualifies it, then it moves up to production. So these are the stage of the evolution. But back to the point that Derek was saying, and actually Richard, should we use implied volatility as well as part of this volatility model that we are, or certainly that I'm working on? And my answer is yes. And I use it actively and passively. Actively in terms of options, trying to incorporate volatility strategies, and passively, should implied vol be an input to this model or not? And my answer is yes there as well, and it shouldn't be a surprise, because I was talking a couple of weeks ago about measuring your realized volatility or your strategy's realized volatility versus implied volatility, and decide sort of how much to allocate between option or volatility products versus futures or trend following strategies, or your multi-strategy, your system strategy. So yes, I mean, like, yes to all of the above. Basically, I think implied vol is important. We need to understand, to minimize lag. Obviously, implied vol helps. The question is, what are you doing with with the implied volatility premium? Meaning the fact that most of the time, implied volatility is just insurance, so it's quote unquote overpriced versus risk-free models. I actually don't believe in risk-free as a framework, but this extra premium is something that should be monetized. So sometimes you want to monetize that. Sometimes you want to pay up because what you perceive to be a premium in reality is just a massive discount. Like last Thursday, if we all went out and bought a boatload of puts, we would be feeling a lot smarter this week. So yeah, I mean, like there are ways to use implied vol, and in the model that I'm working with, implied vol is one of the parameters. So it has a lot of importance to me. Finally, the minimizing lag. I don't know. I'm not particularly. I know that I'm a stupid trader, and I know that I don't have an information edge. I do not have informed flow at all, so I don't really mind getting a minute or so late, or a day or so, or a week or so late. The point is, I don't want to be the last one. Ideally, my position would be the last of the first, rather than the first of the last, but certainly not the last of the last. But staying up there is good enough for me. So I'm always accepting a certain amount of lag. I don't want to fit my model for that. I just want to be precisely measuring market conditions.
I think you should take over the role of Donald Rumsfeld, Bruno, with some of the statements you're making. They're gorgeous. But listen, the implied volatility, I was actually thinking in a sort of more a contrarian nature, isn't it? When implied vol is low, that's when you start taking out your options. So we actually use it sort of in a counterintuitive way, as opposed to using it as a measure for volatility itself.
To Bruno's point, paper by Cliff Asness comes to my mind, which he wrote about 3 years ago, which was called, contrary to this Clubhouse's topic. He said, "Stop talking about the VIX so much," and where he sort of uh, he regresses the difference between the implied vol and the realized vol, and he finds that to be within like a half standard deviation difference. So that the difference is very, very small. To the other point of how to use change in Wix, or how to use Wix. So I've been doing some research on, I run a momentum system on equities, and with which is about a quarter, which is rebalanced every quarter, rebalanced every month, and so I was looking at the methodology that iShares uses, which is basically uh, the methodology used by MSCI, and tucked in away in an appendix, somewhere deep down, they have a condition for an ad hoc rebalance measure where they use volatility. So what they use is that if there is a change in the volatility which is over the 95th percentile, that calls for a ad hoc rebalance, and they've done this a couple of times in the past. I think it happened in May of April or May of 2019, where initially it looked, the rebalance looked pretty dumb. They went out of some high beta stocks and went into low beta stocks. But as the year went by, they started looking pretty smart. So, I and that literature is there. I'll sort of post it with Derek link to the Clubhouse. So I think that should make for some interesting video.
I find that very interesting. I do believe there's a rebalancing premium. I mean, if you're talking about pure portfolios like an MSCI index, or even if you're thinking in pure portfolio weights of just holding stuff, there's definitely a rebalancing premium that occurs. I think the volatility drag slash, I don't want to say ergodicity, but like the path dependency increases. I definitely want to take a look at that paper, but um, going back to this options world and go in talking about ATR. Oh yeah, I wanted to put out a different model that people may not have heard of. I mean, maybe you've heard of it. Is the Yang Zhang volatility model. I would say it's slightly improved. I mean, we'll say that ATR gets you the 90% of the way there. This might be the extra 10%, and how it does that is compared to a close to close, it's 14% or 14 times faster at converging in a return space to the true volatility. It also takes, but the most important aspect that I don't believe ATR takes out is it deals with volatility drift. So we have this clustering aspect in the volatility, and if you could remove that drift, you would have like the pure part of that. And because when we sample, right, these rolling windows, we have a lot of overlapping samples. So that overlapping samples can also create some bias in your volatility estimation, but it does take the high and the low, and it's looking at that type of thing. So it's something to put out there. I can put a link to the formula or whatever, but it's pretty well known.
Jerry, you've been quiet today.
Yeah, I'm not sure where I fit in. So I do pay attention to volatility. I do calculate it daily. I use the ATR, and I keep my units based in original entry ATR, and I look at them based upon current ATR. And I look at the performance on each chart. I have a chart and a study at the bottom of my chart that calculates the day's move in terms of today's ATR, which usually understates the volatility in my portfolio because these ATRs move up. But one of the things I've tried to do is optimize the ATR calculation based upon the back test, and that would be how it's calculated. I've tweaked it a bit, I think, to make it more accurate, and then of course the number of days to use. And then as a check, I wanted to find a better way to see how accurate my ATR was. And I figured that ATR has a very unique, well, not very, but has a unique characteristic in that it should, um, your calculation of ATR should produce over a good sample size an average move per day of 1/2 ATR. So I like to hit these problems with two different ways. One with the back test, but then confirm with a spreadsheet that yes, if you look at enough days, my ATR is spot on because the average move per day, the net change per day in terms of ATR, my ATR calculation is 1/2. And I was noticing back in the 90s that that was the case in the bonds, but it was not the case in coffee, for instance. So some of the less liquid markets, they using the traditional ATR, my average move per day might have been 2/3 of an ATR. And so I was understating the ATR because it has some flaws, I think, in it that where it adjusts for gaps. It's not adjusting enough for gaps.
And Jerry, do you think that's that difference between coffee and the others was a case of the gaps only, but still the same principle applies in that this ATR, through its normalization method, we can get some standard level of ATR that is applicable to all markets, or do you think that we need to streamline our ATR to be market specific?
No, not market specific for sure. But I guess so I think the gap part is not sufficiently, because if a market gaps down at 8:30 in the US, it doesn't mean that overseas it would have traded much higher on the day and then made new highs, and then it gaps a lot lower when the US opens. So I think that's what the adjusted ATR needs to take into consideration. That and so a market that trades 24/7 virtually like the bonds, it's not missing this gap. But the coffee, maybe not so much now, but some markets, even if they're not that liquid. So anyways, your bogey is how do I make sure when I test the net change in terms of today's ATR, yesterday's, and the day before, that its average move per day is 1/2, and that's a pretty easy thing to solve for.
Thanks, Jerry.
And I want to say hello to everyone. I want to say that it's maybe another topic, but I want to say that I like the idea of not changing the RTR stop during the trend environment. I like that idea much because I saw I had a lot of backtest on this topic, and really it works really good. I like that very much, not to change RTR. So I, for example, do my stop loss order once, for example, 2 RTR, and it does not change under any circumstances.
That's interesting, Oleg, because I certainly do in my trailing stops, which also uses ATR. If we've got very high volatile periods of this trend, my trail will be slow to lift up. But if we've got sort of low volatile trends, it'll be ratcheting up more quickly. But yeah, look, I sort of I came to that conclusion through my data mining efforts. So I was using a research process to achieve that through extensive data sets. So yeah, it's interesting. We've got two different philosophies there.
Yeah, going back to this gap thing, this young jump volatility does also cover the gaps or jumps between days. So I mean that's really those three aspects are why I like it a lot. And I think I'm aligned with Richard on the changing of the stops.
Can you post that link, Derek, to that Yang model?
Yeah, sure. I will post it onto the same tweet that Anish did.
Thanks, Derek. How did everyone go on Black Friday? That's what I want to know.
Not well. Not well.
Most of the damage was occurring when I was on Jerry's Clubhouse. Thanks very much, Jerry.
Yeah, and then I went quickly to analyzing my fantasy hockey team. So I think these distractions are good. It's nothing's good's going to come out of it. There was a tweet recently somewhere. Oh, I think it was Taleb. I don't remember exactly what it was, but it was a pretty good one, and it's basically saying if you do something about it before it happens, not after it happens. So I've been burned so many times, and with trying to do a preemptive liquidation or worrying about Black Friday or any sort of black day. And, it's like when and stop with the discretion. I've never been very good at any of that.
Yeah, look, our medium-term and long-term models, they take up the slack when the downturn gets serious with the directional decline or the directional volatility. But as Taleb's sort of suggesting, the best time to have insurance is when everything seems hunky-dory and there's no problem. And I just can't help but feel that would be the optimal time to buy these options because that's the cheapest price you're going to get for them when implied volatility is low. And maybe that is sufficient to close that gap that we're finding with these rapid downturns. So this COVID outbreak, March 2020, Black Friday, we're going to get probably more of these rapid events that occur that do catch our slower models unawares. So it's very tempting to start looking into this use of long vol options plays just for that short-term move.
And I think it's probably more important from my perspective to trade larger and trade as large as you can. As Bruno was saying, let's pay attention to the drawdown of the closed trade equity. There is no drawdown in the closed trade equity because the open trade equity always exceeds that drawdown. But that's semantics, maybe. Okay, so there is. We can go ahead and assume that there is a drawdown in the closed trade equity, and this is what we should be concerned about: our win rate, our average loss. But if we maximize to a large degree how big we can trade based upon this closed trade equity drawdown, like Mulvaney, let's say, then when the dust settles, he is going to have the worst drawdown more than anyone, and yet probably have made the most amount of money. So I think the way to attack this is, oh, that was really unfortunate that I was up 50%, now I'm up 30. But I'm up 30 and none of the rest of y'all are. And you know what? I followed my system to a T, unlike others or you, Jerry, who try to nibble around the edges and call the high in corn and soybeans and bean oil and watch it make new highs again. And that's just a losing game. But I think that's what Telev was getting at, is when you get these massive profits, take profits at the high, because that's what's going to help. Unfortunately, the markets have a tendency to keep going, and there's a long list of those.
I do have some options that were taken on the Friday. For the long vol position, I do find it helps, but again, like it's such a small part of the portfolio. But it does help with the unrealized P&L part. I keep forgetting what you guys call it. Like there's the closed P&L and the open P&L. It helps that, but then the question becomes, if you don't care about that part anyway, then the hedge isn't going to do anything. So unless you're able to monetize that and have a completely different system to operate around that, because if you just like let the option sit till expiration, the chance that it's going to expire in the money is like pretty low, or vol will crush before it expires and then you end up with like a lot less. So there is a lot of complexity there. I it really aspire to be able to like generate Jerry level returns and be able to sustain that. I don't know. It's a goal to strive for.
Yeah, I agree with you. Jerry and Mulvaney's returns are pretty enviable. But you just touching striking the right chords there. And I think I sort of made this point a couple of weeks back in sort of defending my, let's call it vol targeted. Hopefully you guys understand that it's not simply standard deviation following and targeting, that kind of thing is a bit more. But this idea that I have in mind is being able to do exactly what you were suggesting, Derek, and what Richard seems to be hinting at, and is this gamma monetization is monetizing, because I think in one of those Neil's wonderful volatility podcasts there was this example of the guy that said people, some real asset managers were really good at putting on collars ahead of the Lehman moments, but they never monetized them. So there were long dated trades, and by the time they rolled off, they were worthless. So they spent money for nothing. They had the perfect hedge on. They just should have acted on it. They didn't, and so it became completely wasteful. What I'm trying to do is the opposite. I'm trying to figure out a way when I know Jerry said it before. You should take profits just before it happens, and I know it triggered him when I made the comment that we need to figure out ways to protect our profits when we need them most. But that's exactly what I'm trying to get at. My ideal would be to develop some sort of monetization mechanism, partly with volatility contracts, but also with standard sizing of positions in order to extract the convexity, the upside convexity of trend following, but without suffering too much when things sort of just chop around.
I think that's the holy grail, man.
Probably
To
the
be
book
able
of
to
dreams.
identify that. Yeah. I'm thinking. I'm sorry. I'm have my mic on, but also thinking to myself. Okay, so in this volatility context and this measurement, and understanding that options are the uh, fast volatility, fast movement, and then thinking about the different types of portfolios that we have in this group. Some people care about only closed assets or closed net asset value, and other people care about open mark to market. I think you have two different ideas that require two different tools, because if you're trying to maximize your closed position profit, you need something that's taking off position at those highs, which seems to me to be exactly vol targeting in the classical sense, because we're saying, okay, volatility has increased, and then you should slice your position because this may be the high. We have reached a new regime. The taking to the ideas that we've discussed here, semi-variance. What if you, instead of just looking at pure vol targeting, you did semi-variance targeting, whereby, okay, there's a bit of lag, but now, okay, I'm having upside volatility, we're making new highs, it's cool, leave it on. If we have downside volatility or something that's going against my position, now I should be looking for the regime change. Obviously, it adds additional complexity, but you would be able to maintain that, because you want to keep that right tail. You can have the lag part for a closed equity, and then this would basically get you out before your trailing stop. In the option side of things, like Bruno was saying, you have this monetization issue. You will have instantaneous P&L for these things, and if you think about where the VIX was before, it was already hanging around 20, 23 Thursday, and then it went up to like 36-ish, I think, around. Yeah, okay, that's a significant move in the vol space, but actually the price move is pretty small. If you think about, like, you're holding S&P puts and you're paying 20 vol on it, and from the VIX, and then your price moved down 2.5%. This is not crisis. This is not something necessarily that a tail hedge is going to connect with. You might get a bit closer to your strike. Vol has increased. You're really making money on the vol part. You're not really making money on the delta part because you haven't started to really approach your attachment point. And we'll define attachment point. That's the point at which you're looking to protect. And we'll say most people are trying to protect things like 10% moves. That's like a real tail event. That's a real crash. Maybe if it was in commodities, like just getting to limit down. Like you want to get something that's going to activate when we get to limit down, so that if something goes wrong and I get limit down the next day, it's going to protect you. And I find that it's the really weird part about this market post-COVID. Not only do we get vol up, spot up, we get like very high vol on very low moves down, and people really freak out. Like I don't know, I know we don't watch the news, but like the news has gone bananas. We had 1.5% down day in S&P. Then we have like another 2.5% that used to be considered normal. That is not something people are hedging tail risk against for a collar, right?
What grabbed me on Black Friday was that every single one of my directional trends was influenced in an adverse way. So this correlation suddenly appeared across everything I held. I was just wondering, did any of you see any markets that were uncorrelated to that general trend?
I will say crypto lagged. It was still holding up pretty well, but then eventually capitulated. And I think that you're getting onto something here. The new book by Hari Krishnan, he's been interviewed recently and had a few episodes on TTU, is called Market Tremors. And the idea is that we have these dominant agents in the market, and that they can cause these like kind of one-sided moves through liquidity cascades or whatever. And if you're using his framework, our old friend JP Jerome Powell saying that he's getting more hawkish and that kind of thing would have been the dominant agent in the market, telling the market that in fact we're going one way, more hawkish, and that causes all the correlations to instantaneously go to one, because you have this one dominant person basically changing the rules of the game. I liked the book in the mental framework, but I didn't get that many tools out of it. Like there's nothing that like I can use to actually measure something. But this idea that the speed of news, this all central banks, whether you're ECB or Bank of China or the Fed, are dominating the moves now, I think is absolutely the case, and it works for better or for worse. In that they can create large outsized trends, which we had been needing since, say a few years ago when things weren't that much. But then the turning on the dime aspect will only be exacerbated going forward because of the material nature of their ability to affect liquidity in capital markets.
What I find interesting is, to answer Richard, yeah, everything moved together. But I found that this was perhaps uncharacteristic of how things move these days. I find that it's more common for crashes or crises to hit single markets at the time. So you're going to have a problem in oil, like oil price going negative, and then you have this lumber going parabolic and then crashing. Then you have some other things. It seems like sequential, and then very rarely happens that everything is correlated. And obviously that traces back to good old leverage. One thing we're not talking about is leverage and path dependency, which are not the same thing. Convexity, leverage, and path dependency are sort of intertwined, and people sort of think it's one and the same, but it's really not. Leverage obviously brings good things to convex payouts, but you couldn't say that the opposite is also true. It can be disastrous if you have negative convexity or concave payouts. Leverage amplifies and speeds up, that margin call that you're going to get. So I think what happened, or what might have happened on Friday, is that some people got a bit spooked somewhere, and we're going to hear about it probably in a week or so. I don't know where it came from, but there must have been some sort of tremor, external tremor. Some liquidation, fast liquidation in a very, very illiquid market. Everybody was out, digesting turkey in the US, and as in Europe, we're sort of playing because Thanksgiving is sort of a holiday for us as well. So, this is what could have happened more than a a change in correlation structure. It could be that there's some liquidation happening, but it doesn't really matter because when these cascade events start taking place, then correlations follow. Like everything sells off. So yeah, I think it's been very interesting. I don't know what happened. I can't comment on anything because I'm largely ignorant. But it something was different about this Friday for sure.
It's so funny. That last part, I was following you, Bruno, all the way to that last part. I could never accept that it's different this time. That is like one of my number one things where it's just, I probably don't understand what's going on. And I will definitely key back on this book and also we talk about liquidity cascades. Um, if you think about the correlation structure with things, and normally, yes, if the system, and we were talking about complex adaptive systems here, right? If we believe that the problem is endogenous in the system, it's originating from in the system, the baton will be passed. The market that's causing the issue and the liquidations will be passed to the other markets surrounding it. So you could think, okay, well, gold, they're going to run to gold, or they're going to sell down their gold to meet their margin call on the bonds, and then the bond, so the bonds was the originator of the move, and then liquidate to whatever comes. But if it's exogenous or coming from outside the system, then it actually impacts the whole system at once. And that's where I think this concept of these dominant agents in a complex adaptive system, in a networked environment that can put external pressure on the whole system at one time, creates an instantaneous change because everyone is affected all over and everyone is in the TINA trade, right? Everyone needs to have some kind of equities at this point. Um, Everyone needs to have some kind of fixed income. So you're affecting both of those aspects at the same time. Now, I don't think that that's necessarily measurable unless you're doing like reading the news, parsing the news, and able to react ahead of time. But I do think that's a new dynamic. If you think about how fast news traveled before, like the Greenspan era, not only was the Fed not signaling as much, but also, you would hear the news or you'd see it on TV, or you'd see it in the newspaper, and then people would react slower. The pace of the participants would also move slower because you didn't have HFT. Now the news is spreading faster and the participants are faster. Thus, maybe there could be a point, I think, if I want to take this to the limit, where instantaneous changes in correlation will happen and we'll get less batons passed as we get more global trading, more people trading everything because they've searched for yield or whatever, and then all of these things, instead of going from Asia to Europe to US and back again, the more 24 hours markets we have, then actually everything will move as one.
I was just reading Niels's update on 1st of December, and he says that out of 55 markets, only 9 markets were positive and the rest were all down. So that's directly a point of how correlated things are. And, it just reminds me of this 2007 event called Quake, which went reasonably unnoticed outside of, the world of quants and it's sort of outlined in the book Quants and also the recent book on Jim Simons, where it was basically a massive liquidation in the credit fund by Goldman Sachs, and all the factors were working, the exact opposite the way they were supposed to work, and everybody's positions were getting hit at the same time because Goldman was liquidating. And all the guys from AQR are calling Citadel. Citadel is calling Morgan Stanley. Morgan Stanley is calling Renaissance, saying, "Is it you guys?" And they're saying, "No, it's not us." The only guys who were not saying anything was Goldman Sachs. So that's where the problem was. But nobody outside of that world of quant really noticed this. Then there's a great paper by one of the last good papers by a Lehman analyst. I forget his name, but I have that paper where he outlines that quant quake, and this was in August of 2007, and that was basically a precursor to what happened later in 2008, but fairly unnoticed. But that kind of event would not have gone unnoticed, I think, in today's day and age. Derek, also, can you repeat the name of the book you were referring to?
Yeah, Market Tremors by Hari Krishnan.
Okay, thanks.
I like his book Second Leg Down. I think Second Leg Down is much better. It's about vol and hedging. So if you guys are interested in that and using options, I would say it's probably the most practical book on hedging tail events. And that's why that's how actually I knew him to follow to get this second book. But I would say the first book is more practical application. The second book is kind of mental framework, macro framework on thinking about who may cause these things. So like being able to pre-identify that Goldman Sachs has these credit funds through network effects, and then kind of measuring these kind of things. I mean, he doesn't have really measurements, but like mental framework of measuring, okay, who's the biggest player. And that's why I believe the Fed is probably the biggest player right now, because everyone is just not going to fight the Fed, hence you must be following the Fed.
I've got a bit of reading to do over the Christmas break. Thanks for that, Derek.
All right, guys, I think everything's kind of winding down, unless someone else has some topics to bring up. All right. So thank you, everybody, for coming. As always, appreciate Richard for posting the recordings. I will put that up in my morning because normally I go to sleep after this. But yeah, thank you, everyone, for your comments. Also, please DM me, reply, whatever, with new topics. I always like to keep it relevant to the people, and I will post the poll, the weekly poll.
I think, Derek, you mentioned factor investing as one of the topics you wanted to talk about. So I think that may be interesting maybe next time or some of the others.
Sure, I'll make sure to put factors on the poll this time, and let's see if it wins,
See you guys.
See you
Thank
guys,
you.
everyone.
Bye.